We've been waiting for Tata Motors numbers all day long. Finally, they're out. Consolidated net profit stands at 3,580.7 crore rupees. We were expecting 4,846 crore rupees. So, on a consolidated net profit bottom line basis, that is definitely lower than expected. Remember, on a consolidated basis, our expectation was fairly high. And on a standalone basis, we were expecting to see some amount of pressure when it came to the margins, when it came to the top line. We'll try to get Sonia on the phone line in just a bit. But all in all, on the bottom line, the number seems to be slightly disappointing. Do we have a guest with us? We'll get you some reactions as well. But remember, on the consolidated revenue bit, we were expecting revenues to come in at around 66,110 crore rupees. So let's just wait for that number. But given that the bottom line has come in slightly below expectation, we need to wait and watch out to see where the top line performs. Let me tell you what else we were expecting as far as consolidated figures go. We were actually expecting the JLR revenues to kick in the overall top line growth. So on a JLR basis, we were expecting revenues to come in at around 5,500 and consolidated revenue is out. Better than expected, 69,973 crore rupees. Definitely. So if bottom line was a miss, the revenue is better than what we were expecting. We were expecting 66,110 crore rupees. So we were expecting a growth of 3.5% at 69,973 crore rupees. That is above 4 to 4.5% roughly. So this is on the top line better than expected. As you can see on your screen, we are expecting the management to just talk in some time. Remember, watch out for the JLR numbers now that the revenue has come in better than expected. Quick recap, 69,973 on the top line. Net profit coming in at 3,580.7 crore rupees. While it's a miss on the bottom line, it is definitely a beat when it comes to the top line figure. We were expecting the JLR performance to, as I was saying earlier, to kick in to the overall top line. So JLR performance will be very necessary. We need to watch out for the revenue coming in from JLR, the kind of profit margin that we will see from JLR, and also the operating performance on a Q-on-Q basis. We have a guest with us. Guys, sorry, do we have a guest with us yet? Yes, we do. We have Nishant with us. Nishant, we have the basic numbers on us. 69,973 crore on the top line. Bottom line, 3,580.7 crore rupees. Your quick take.
Yeah, I think on the JLR front, at least the sales is a beat. Okay, and however, the EBITDA margins, as reported, are at around 18.6%, which is effectively on a percentage basis lower than close to 80 to 100 basis points on the street expectation. I think on an absolute number, JLR EBITDA is higher, but on the percentage basis, it is lower. I think they are really not able to get through the one-offs that are hit the bottom line, because on the absolute basis, considering the fact the EBITDA is strong, I think it's okay, but they'll still have to go through the detailed numbers.
Let's just go a little bit more into the JLR figures, Nishant, but because JLR was supposed to be the saving grace this time around. Can you break up the JLR performance based on your expectation? You're saying that JLR performance on revenue, on EBITDA is better than what you were expecting?
Yeah. So on that front, JLR performance is definitely better. We were expecting around 5.7 billion on pounds in terms of revenue, and close to 19.5% on the EBITDA margin.
Okay. So Nishant, quickly, the operating margin has come in on a consolidated level at 14.4%. We were expecting it to come in at around 17%, if I'm correct. Is this in line with what you were expecting? 14.4.
No, obviously there are one-offs in the results which we are not able to get a hang of as of now. But I think the key focus should lie on JLR and JLR's margins, because as of what I can realize is that on a PBT level, the number is slightly higher at 685 million pounds. So there has been a probably higher tax rate. So I'll just need to get through that number.
Okay, there are definite one-offs there, Nishant. Piyush Jain is also with us. Piyush, quick update. So on the bottom line, it seems like a miss. Top line is definitely good, but operating performance on a consolidated level, 14.4%, lesser than what we were expecting. Your quick take on the headline numbers?
So definitely, as you said, top line was basically better than our own estimates. But when I look at the JLR number, I think the JLR margins are also lower than what we were thinking. I think one thing is we'll need to see the impact of revaluation. But even if I look at the pure trading profit number, it appears that they had to use higher discounting to offset the basically lower demand European market.
Piyush, the Tata Motors management is talking as we speak, so we'll get all the answers. Let's just quickly cut across live.
Level continues strong at 15.4 compared to 16.6 same period last year, and profit after tax 3,581 crores compared to 4,800 crores. Similarly, for the 9 months period, turnover was 1,95,000 crores, EBITDA margin at 16.8%, and profit after tax 12,270 crores. At the global consolidated level, the net automotive business of the company, the debt equity stood at 0.15:1. However, in India business, the net revenue came in for this quarter at about 9,000 crores, up from 7,700. EBITDA margin was negative at 8.5%. We'll come back to this shortly. Profit after tax was negative, loss of 2,100 crores compared to a profit of 1,251 crores same quarter last year. This year's EBITDA margin, EBITDA 774 crores negative, included provision that we had made due to the uncertainty in the timing of the decision regarding the capital assets we have in Singapore. That's well over 300 crores and certain other one-time provisions. Profit after tax last year included the profit on account of the restructuring that we did within the group, transfer of certain companies overseas from Tata Motors to our Singapore holding company. That profit was reflected in the Q3 results of last year. 9 months, April to December, net revenue was 25,000 crores, almost flat, same as last year. EBITDA margin negative, influenced mainly by the current quarter at 4.5%, and profit after tax 3,500 crores negative. At the standalone level, the net debt to equity was higher than 1:1 at 1.22. Jaguar Land Rover net revenue for the quarter up from 5.3 billion pounds to 5.879 billion pounds. EBITDA margin 18.6, slightly lower compared to 19.1 in the last quarter, and profit after tax for the quarter 593 million pounds, almost flat compared to 619 in the same period last year. For the 9 months period, Jaguar Land Rover reports a turnover of 16 billion pounds, up from 14 billion. EBITDA margin for the year, 9 months, 19.4, up from 17.6, same 9 months period last year. And profit after tax, 1.7 billion pounds, up from 1.4 of last year. Net debt to EBITDA, net debt to equity in Jaguar Land Rover continues to be negative, which is a positive sign. Negative net debt at 0.24:1. In our India business, we saw growth in the M&HCV industry segment, triggered by positive business sentiment, firm freight rates, and improved freight availability, fuel prices, slight easing of inflation, and improved profitability of the operators, and the replacement demand for the fleet beginning to happen. However, the LCV segment, mainly the small commercial vehicle, continues to be impacted quite heavily. Low transportation tonnage and vehicle overcapacity, and constrained and risk-averse financing environment for the operators. For the industry in general, variable marketing expenses continue to remain high, impacting the manufacturer's bottom line. In the M&HCV segment, the company sales in this segment grew by 42% year on year, although compared to a small, relatively low base. And market share, we ended the quarter with about 57.7% in this segment. We launched the Prima trucks in Nepal and Ultra range of vehicles in Sri Lanka. Overall, in CV, our market share for the quarter stood at 50.4%. And quarter-wise and for the 9 months period, you can see the decline in numbers. In our passenger vehicle business in India, the industry witnessed a growth of 4.3% on the back of low vehicle ownership cost due to, again, reduction in fuel prices, continued improvement in the economic environment, GDP, IIP and other factors. Our business in passenger vehicles grew by 4.6%, slightly ahead of the industry growth. And within that, our car segment grew by about 16.9% year-on-year. After quite a few quarters, the market share in the car segment, we showed an increase by about 60 basis points. Our launch, the Zest, has won multiple awards in the compact sedan segment since its launch and is receiving strong positive demand in the market. Jaguar Land Rover, the retail volumes for the quarter was 122,000 units compared to 111,000 units. EBITDA, as I mentioned earlier, a little over £1 billion for the quarter. Margin came in at 18.6. This is mainly caused by the wholesale volume increase, good product mix, Range Rover and Jaguar F-Type, good market mix, strong sales in UK and China, and favorable foreign exchange offset by less favorable realized hedges in our hedge book. Profit before tax, 685 million, down by about 157 million year-on-year, despite the higher EBITDA, since it was offset by unfavorable revaluation of foreign currency, debt and unrealized hedges, and higher depreciation amortization charge, which we have been talking about in the earlier quarters. We continue to invest in the future growth. The capital spending was £2.33 billion for the 9 months period. Post this investment in capex, free cash flow for the company for the 9 months period stood at positive £456 million. Retail sales of Discovery Sport and China JV Evoque will begin in Q4 this year. And XE, the Jaguar XE, will go on sale from Q1 of next financial year. You also have the pie chart in terms of the geographical distribution of our sales in this quarter compared to Q3 of last year. Similar trend. Looking ahead in the commercial vehicle, the positive investment and business sentiment, the government reforms, continuing lower fuel prices, and moderation in the inflationary trends, and the interest rate cuts, we expect the automobile sales are expected to show improvement in the next financial year. M&HCV growth is expected to be more comprehensive and sustainable in the next financial year. The SCV segment, the small commercial segment, however, we believe will reflect growth perhaps from Q2 or H2 of FY16. JN and URM phase 2 orders will continue to drive to some extent the bus volumes. We continue to have and invest in a wide and compelling product range with several new launches in Q4 of this year and FY16 across the Prima and Ultra range, refreshes and variants in small commercial vehicles and pickups, and export will continue to be a high focus area. In our passenger vehicle business, new products and mid-cycle enhancements to drive growth. We will have the full year volume of Tata Zest and Tata Bolt next year, and the volumes of Nano Twist, Vista and all new Tata Ariya. New generation models, as I said earlier, will drive growth and gains in market share, which has started happening in this quarter. Product plan is well defined and firm till 2020. Our aim would be to launch 2 new vehicles, which are being planned every year from now on. and we will continue to avail opportunities in the international markets.